Hello, everyone. We are back finally. It feels like for ages that people will not even recognize this, right, Glenn? That we have maybe paused, but for what it's all good for, we have Julius back. Our how do we call this now? Our very own labor economist, our in-house labor economist, yeah, for our podcast only. And this is really cool because we're excited to talk today a little bit more about. The UK and the labor market there, and what you need to be aware of. We did this on the other episode, which worked very well on Germany, and I think now we spend a bit more time into the UK market, which I'm very eager to hear and see and listen to. So I'm probably not the expert, but hey, Glenn, very happy to have you again. Do you want to say a couple of words? Maybe I missed something.
Yeah, absolutely. I mean, as you said, we took a short break, as all kind of podcasters should, just to kind of refresh and re-energize. And I think we're super excited to be back with Julius, our kind of European labor economist. Not that he signed up to being our regular guest now, but at the same token, we're hoping to convince him that this could be a really good thing. So thanks to Appcast for kind of giving us an hour of Julius's time. And I think that you're absolutely right, Matthias. I think the key focus here is trying to, back to the kind of focus of the podcast, escape the echo chamber. Are we looking at kind of green shoots within the UK economy, or is there an underlying volatility that essentially we need to be aware of from a people and talent perspective? So if we just kind of put that into a little bit of context, the UK has 0.7% growth Q1 2025, which is the highest of the G7, but equally to counter that, it's got probably the highest inflation rates predicted for 2025 at 2.7%. So, you know, where is the kind of UK economy, and what does that mean for people and talent, folks? But before we get into all of that, Julius, welcome back.
Matthias, Glenn, yeah, thanks so much for having me back on the podcast. Very happy to be here. And as you mentioned, I'm the labor economist working for Appcast. Appcast is doing programmatic recruitment. We're part of Stepstone, which is a large European job board company. And yeah, let's talk a little bit about the UK labor market, shall we?
Absolutely. Well, set the scene, Julius. Tell us what you're seeing.
Sounds good. So as you mentioned, let's talk a little bit about the economy and labor market. The UK had pretty strong growth in Q1. Very strong growth, actually. That was a tiny little bit of an outlier. If we look at kind of the last one and a half years, the UK economy has been growing at a rate of about 1%. That is not spectacular. It's not fantastic, but it's also not bad. To put that into perspective, Germany over the same time period almost had zero growth, a little bit of a recession even, right? So growth in the UK has been fine. The labor market, however, has been in a little bit of a downturn over the last, let's say, 12 months. If we look at the unemployment rate, that is now at about 4.5%. That is a little bit higher than it was 1 or 2 years ago. So it's been kind of like ticking up from about 4% 2 years ago to 4.5%. That is not a massive increase, a minor increase, but obviously like a little bit of a concerning trend. One thing to kind of like keep in mind here is that the ONS, the UK National Statistics Office, has a little bit of problem right now to accurately measure the unemployment rate. So there's more uncertainty about that number. And why is that? The way they measure unemployment is that they send out surveys to thousands and thousands and thousands of households, right? So the UK economy has like 30 million people in employment. They don't ask every one of these 30 million people, are you employed, are you not employed? They're sending out thousands of surveys. Yeah. And they're trying to get an accurate kind of like measure. They're measuring the statistics. They're trying to get an accurate measure based on a subsample, right? But if people don't respond to these surveys, which over the last few years, fewer and fewer people have not responded, then there's potentially a measurement problem. And so over the last couple of years, they've been saying that this unemployment rate number might not be 100% accurate, unfortunately, which is a problem. It's also a problem for policymakers. It's a problem for the Bank of England. But there's other data we can look at, and that data is more reliable. So one piece of data I'm looking at is payroll employment. That is the number of people who are employed. So it excludes people who are self-employed, but anybody who's employed by a company, basically, or pay on payroll of a company, right? And so that's about 30 million people who are payroll employees. And that data is coming directly from the tax authorities. So it's a better measure in real time, right? And so we know that over the last 6 months, the UK economy has roughly lost about 150,000 payroll jobs, unfortunately. So it's not massive, given that there's 30 million people employed, but it's obviously a concerning trend. And so this trend has kind of like started with last fall, around kind of like, let's say, September, October, shortly after the labor budget. And my best guess is that the current labor market weakening has had to there was quite a big causal effect. So the policies that labor implemented back in October, that you probably also know about, Glenn, they had a negative effect on the labor market right now.
Yeah, absolutely, and I think it's interesting that you're kind of quoting data there, which is obviously a key source for us. But there's also that kind of sentiment, kind of public sentiment around how the economy is looking and feeling to them on a kind of day-to-day basis, what that means to people in terms of their kind of disposable income. But yeah, Labour's kind of policy specifically around kind of employer contribution to kind of NI and tax was a really stark kind of almost like a lightning bolt for employers to think about how they will. Well, I mean, it certainly impacted their thinking, I would imagine, around kind of forecasting for hires and investment in their existing teams. It was definitely a bold move by Labour. Their rationale seemed to be, kind of sound, but at the same token, they must have predicted some level of negative impact on that. But yeah, Matthias, how does that look and feel in relation to comparative to the kind of German market at the moment?
Yeah, I mean, Germany, as Julius mentioned, from a growth perspective, is also much more in trouble, I think, than you guys over there. But again, I think we have also now a new government, and we are really excited to see like what's going to happen and how do they actually tackle the productivity topic. Yeah, I think this is a huge ongoing conversation at the minute. There are some, very much like, we need to work harder now to actually get to retain our wealth, right? But is it really working harder, or is it, when you look at the data, and this is also something similar, you probably have also followed this. Again, there are two data topics that show different things. So one thing is, yes, we work on average less, and compared to other European countries, that is true. But the amount of part-time employees that we have, which reduces the overall time of employment of employees overall, the amount of part-times are women, right? Women who have other jobs, they cannot make sure that they have full-time commitments. And why is this? Because yes, kindergarten and coverage of small little kids' schools, nursery, whatever it is not there yet, and it does not help, especially women, to really increase their days or the hours, right? And I think this is another thing that we currently see. But I think one last thing with Germany is, and I think the UK is much better there, we are very industry-heavy economy, right? So that means with what you guys have, for example, our business model was always like, you want to go global, export-driven kind of economy, but we are industry-heavy. You guys are service, consulting heavy, right? So I think this is something which is an advantage because we are not there yet, right? And I think we need to become more even from a technical standpoint and digital transformation standpoint, we need to get a little rid of the industry-heavy economy, which is something the current government is not going to touch because they are saying we are afraid because it's too much of a hassle, and they are just hoping to get the economy going and then might do some further changes.
Yeah. I mean, we'll get into that because obviously the kind of difference in the kind of market composition is one thing that Julius wants to kind of really delve into. But Julius, just as a kind of a step back, I read something, and I don't know kind of how accurate this is, but the OECD kind of reported that the UK are actually at risk of breaking their own kind of fiscal rules. And I wondered how, or whether you had an insight in that and how that kind of reflected in comparison to like Germany or Spain or Italy. Because I think that, you know, part of the reason why perhaps the Labour government has to have been so aggressive around its kind of fiscal policies is because if you're close to breaking your own fiscal rules, that's not great when it comes to kind of trade, when it comes to negotiation, et cetera, right? I mean, it's, you know, if you're a weak economy, your negotiation position is weaker.
Definitely. So the UK's fiscal position is definitely definitely way worse than that of Germany, also some other European countries. So the debt to GDP ratio is close to 100%. Interest rates are quite a bit higher. So depending on whether you look at like the 2-year interest rate on government bonds or like the 10-year rate, they are basically above 4.5%. So that is, again, it's quite a bit higher than in Germany. So the UK government needs to pay much higher interest rate on their debt, right? So that's a problem as well. And so coming back to the Labour budget last fall, they actually were, before Labour was elected, they promised, even though the fiscal position is not that great, they promised to not increase taxes on households, right? And they didn't. And that's why they instead increased the employer's national insurance contribution. So that is it was a tax on businesses, basically on hiring people, right? It made it much more costly for employers to hire people and to employ people, and so that is why we had that negative basically effect, that negative employment effect over the last 6 months. Because it was a substantial cost increase, that NI increase for employers. Together with the increase in the minimum wage, actually, here in the UK, which has been substantial as well, right? So the minimum wage has been going up by about 7% almost year over year. And over the last few years, it has been going up at a very high rate. I think for the last couple of years, 6 to 7% for several years in a row. And so these two effects combined, the NI increase and the minimum wage increase, has meant that for businesses that are in, let's say, low profitability sectors, so if you look at hospitality, if you look at retail, if you're like a supermarket chain, a Tesco or whatever, you employ 40,000 people. Now you have like this double whammy, right? You have the minimum wage increase that has increased the cost of employing people, and the NI increase. And so that is why I think we have this negative employment effect, and also a lot of companies reducing hiring or going on a hiring freeze, so a much more static labor market. Did this NI increase kind of like solve the fiscal situation of the UK government? Unfortunately not, I would say. because growth just hasn't been strong enough, and they also promised to increase spending on public infrastructure and a lot of other measures, which is definitely a good thing. It's the right thing to do. I think the UK economy didn't have enough investment, especially in public infrastructure, outside of like London and the southeast of the country. So I mean, where the UK has a lot of like large metropolitan areas, large cities. Think about Manchester, Greater Manchester, few million people there. Think about Greater Birmingham, a few million people there. But just like the connectivity between these large cities in terms of infrastructure is actually quite bad. I must say, to be honest, if you compare it to France and other countries with their high-speed railways, decent, good, very good highways, and so on, right? So I think the UK does need to invest way, way more in infrastructure and other things, but it doesn't have a lot of leeway, unfortunately. So they will, as you mentioned, the UK government might break their own fiscal rules, and that's not the most concerning thing. I think the more concerning thing is kind of like the path of the debt trajectory and the high level of interest rates right now. And so there's only two ways out: either grow faster, have much higher economic growth, which is a hard thing to do. We don't at the moment, with all these global economic shocks, that is a problem. Or potentially, maybe if you do want to do all of that spending, increase taxes again. But that's also a hard thing to do because, well, they said they would take away, for example, what was it, like the fuel subsidies of pensioners, right? And then there was such an outcry that now they are saying, well, we'll actually not do it. So because
a complete reverse, basically,
because they'll lose votes and they'll lose the public sentiment. So
exactly.
so taking basically reducing welfare is a hard thing to do. But at some point in time, we might have to do it. Increasing taxes is also a hard thing to do, but potentially they might have to do it at some point in time.
Yeah, for sure. Matthias, you touched upon it, man, and we'll come back to Julius, but Trump equals tariffs. I mean, that's probably the best way to put it, right? It's kind of like Trump equals tariffs. And what does that mean for kind of Germany? You sort of said about the kind of German government kind of like, the mix in the kind of industry in terms of what's kind of exported. What's just broaden on that a little bit, because that links to the previous kind of podcast with Julius, so we can just draw that in a little bit,
It's funny that you mentioned this because yesterday our Bundeskanzler, our new German Chancellor Friedrich Merz, visited Trump, and everybody was a little bit, how would I say, nervous, to a sense of how is this going to be, the oral office appearance, right? Because we have seen in the last couple of months that this is not an easy undertaking. But it went actually quite well. They were they prepared it very well. They were listening to him well. So I think from the outlook, and I just looked at some reports on TV, they said they were actually quite satisfied in terms of building a relationship with him. And I think when you talk about tariffs, I think we're not going to see tariffs on Germany. It's rather a European Union tariffs negotiation. And I think Friedrich Merz just yesterday reminded or educated, it depends on how you want to put this, Trump, to say, look, the automotive industry here, we have a lot of like German automotive manufacturers are also in the States, and actually it's quite of a market there. So you're putting tariffs on the German automotive manufacturers might even harm him. And at the same time, maybe to our favor, let's see how this goes. But Trump has also a German heritage, right? So the Friedrich Merz gave him a nice gesture where he said, look, this is where you are from and this is from your grandpa. And he was like, oh yeah, we need to put it somewhere where it's super nice. And so he kind of charmed his way to that relationship. But no, honestly speaking, of course it's a threat, right? And tariffs will probably break us because we are industry heavy. And that's why what I've been reading from a German government, but also from the European Union, they keep calm. They are not going into this battle of like, oh, they put a tariff in. No, we put the tariff in. And then we put a tariff in, right? So they actually say, look, let him do some funny stuff and then we'll figure out. Because I think with his approach, he has a lot of critics in the US that say, are you nuts? Like, the investment money is moving away from the US because of the unpredictability that he causes. So I don't really think that Trump can continue doing that further.
Yeah, I mean, it's an interesting one. But Julius, just on that point around how tariffs would affect kind of Germany versus the UK, just kind of give us a bit of context setter there.
Yeah, so I mean, when Trump says when Trump imposes tariffs, right? So the tariffs have to be the same for all countries that are part of the European Union, right? So because it's one trade bloc. So you cannot just impose tariffs on Germany that are different from Spain. So it's EU wide, right? And I think he will impose somewhat higher tariffs probably on the EU, probably not as high as he had threatened, because then there's also these trade deals, etc. But I think at the end of the day, we'll probably reach a stage where tariffs on the EU will be somewhat higher than the UK, just because he knows that like the EU has a bigger surplus with the US and like things like that, and he has been like a little bit more unhappy with the EU anyways, etc. And so now the UK obviously is not part of the European Union anymore, and Starmer went to the US I think a few weeks ago, and there was like a trade deal that's been reached between the US and the UK that is relatively favorable for the UK. It's obviously a worse situation than before Trump was in office, but the tariffs are not that substantial. So how will all of that play out? I think two things. I think Matthias, first of all, is totally right. Germany is more industry heavy. It's exporting a lot of goods to the US, 160 billion dollars worth of goods every single year. So that is massive, way more than any other European country. And so Germany will obviously suffer a little bit more from these tariffs. Luckily, we now have like this fiscal stimulus coming and all of that. So that will offset some of these effects. But just purely from a trade perspective, Germany will suffer more than the UK. And so the second one is not just because the tariffs on the UK will probably end up being lower, but also because the UK is actually much more, and you already spoke to that, much more service oriented, right? So if you look at exports actually to other economies, the UK economy is the only large European economy where more exports nowadays are services than actual goods. The UK is still producing some cars but not that many. The UK is mostly producing services now. So what are service exports? Service exports are literally UK lawyers jumping on phone calls with international clients for a few hours and billing them. It's UK consultants jumping on phone calls, billing international clients. It's financial services. It's fintech. It's any kind of like tech services. Tourism is actually an export as well. It's education. It's foreign students coming to the UK to study. That is considered an export. If I were to consult as an economist, jump on phone calls with international clients and bill them, that theoretically would be an export. I reckon if I had my own consulting shop on the side, things like that, right? So that is mostly what the UK economy is centered around, and obviously with like London being this big main service hub. Full of lawyers and consultants, finance industry, tech, etc., professional services, and so obviously these services you can't put a tariff on these, right? That's so they're exempt from tariffs. So that is kind of like the one big upside for the UK right now. That one, they are not part of the EU anymore. And second, it's such a service-based economy that it is a little bit more immune from the current trade shock. It doesn't mean it will not suffer at all, because obviously if there's a global decline in trade, a slowing global economy, that will affect the UK as well. But purely from a trade perspective, the UK is a little bit more immune.
It's interesting. So, I mean, just to kind of summarize that, we've kind of looked at two positive and negative indicators there. So you kind of guided us through GDP growth, the kind of service sector resilience, if you will, but that's kind of counterbalanced with perhaps the kind of trade challenges. We've looked at kind of household income growth, government spending, and you've kind of indicated that actually increased public spending in kind of infrastructure is going to support that economic growth. And I think that the kind of inflation pressures are pretty obvious to everybody. And then there's the kind of public sentiment or stroke discontent with where we are. On that final point, there is one topic that gets everybody talking in the UK, and that is housing. Yes. Housing is something that is, it's quite literally like lighting the touch paper. You mention housing, even in just general conversation with people, and it's like, boom, everybody's got an opinion on it. And your recent article on it, I thought was fascinating. We'll drop that into the comments so everybody can look at that. But just to kind of, for those that haven't read it yet, just kind of take us through that. UK housing. Give us almost a kind of current status.
Yeah. So I could rant about this probably for an hour. I'll try to contain myself. Let's say 5 to 10 minutes.
There you go. It's such a volatile and emotional topic.
So the UK has, in a way, one of the worst housing markets across advanced economies. If you look at house prices relative to incomes, right? So the UK went from roughly a house price to income ratio of about 4 or 5 in the 1990s to somewhere where we are now at 8 or 9. So house prices are roughly 9 times incomes, 9 times average. The average house price is roughly 9 times average income. And that is substantially higher than in many other economies. And at the same time, interest rates are obviously now way higher than in 2019. So housing is way more unaffordable in the UK than in other economies. And then if you look at the certain hotspots, London, it's obviously still way worse, right? So you literally have large areas of London, or all of London, where house price to income ratios are exceeding 10 or even way higher. And now on top of that, we have the recent changes to the stamp duty, right? So the stamp duty, for people who are not in the UK, it's a tax that you need to pay when you buy a house. If you're a first-time buyer, you are to some extent you have higher thresholds, so the amount of tax you need to pay is lower than if you already were an owner before and you sell your current house and buy another one. So if you're a first-time buyer, that threshold was, however, significantly reduced, right? So the exemption was 425,000 before the 1st of April. And I know that very well because I bought a house on the 28th of March, 3 days before the tax came into effect.
Well done.
Thank you.
Well done.
So, and it was reduced from 425,000 to 300,000.
Yeah. Significant reduction. So if I had bought my house literally a few days later, I would have to pay another £6,000 or so in tax so if you buy a house for 425,000 roughly, that would lead to another 6,000, more than £6,000 in tax. If you buy a house for 500 or 600,000 pounds, and that is nothing unusual, that is literally common London prices, right? If you buy a two bedroom, very small, semi-detached somewhere in the London area, I don't think you can get away with anything below 500-600k anymore. It's probably in most areas of London, it's even way higher. So you literally have to dish out potentially 15,000-20,000 pounds just in tax to buy something, even as a first-time buyer. And that is on top of like the deposit that you need. And let's say for a house worth 600,000, let's say you need at least 60,000 pounds in deposit, I would say. So you literally need, and then you put like the transaction costs for the solicitors and all of that. So you need to already start with savings worth, let's say, 100k if you want to buy anything decent in the London area nowadays, if it's not a flat, but an actual real house, right? And so who has 100k in savings nowadays? If you're a young professional,
30 years old, 35 years old, you don't have that, even if you're a relatively high income earner. That means that the only people who can currently buy, and me, my wife, and I, we got help as well from my parents who are reasonably well off. They helped us with the deposit. And there's research from the Bank of England that most young people who buy nowadays, most first-time buyers, are getting substantial help from the bank of mom and dad, the parents, right? And so that means that the housing market is nowadays like one of the biggest drivers of inequality, because house prices are so high that most people who buy nowadays and are in their 30s or whatever, they can only buy if they have well-off parents. Not everybody has that, obviously. So that is just exacerbating, it's just increasing inequality. Yeah. If you are lucky enough to have rich parents, you can buy in the UK. If you don't have that, you can't buy. And so that is obviously a massive problem. It's a massive problem from a societal point of view. It's a massive problem because it increases inequality, but it's also a massive problem for the labor market. The house prices in London and in big cities are so high right now, and the rents are so high as well, that we all know that the good, let's call them good jobs, because they pay better, the high productivity jobs, they are obviously in the London area or maybe in Manchester and some of the other bigger cities, but it might potentially not even make sense to move there anymore. If you move to London and your wage increases by, let's say, 20, 30%, but your rent increases by 50%, then it doesn't make sense anymore. Then in the end, you lose out. And again, there's so much research that people who rent in London or people who have a mortgage in London, that after housing costs, even though they have the higher paying jobs, the way higher paying jobs, after housing costs, they're actually not better off. They can consume more than people in other parts of the country. And what that means is that labor mobility is way reduced by housing prices. We want people to move to where the good jobs are. We want people to move where the productive jobs are, but they can't. And this changes in the stamp duty have just made things actually worse for housing affordability. And we can already see that real estate transactions, obviously, they were very high before the stamp duty changes came into effect. Now they are they have declined, and I think the housing affordability it's very bad for long run economic growth. It's very bad for society. It's also bad for the labor market.
It's also bad for people, talent leaders and founders of businesses, right?
Yeah.
So if you're sitting there going, okay, well, people can't afford to live in London, suck it up. Well, actually, if you're running a business or you're trying to hire talent and in your article, it indicates a growing trend of, kind of talented individuals migrating away from cities.
Yeah.
So therefore, the actual mobility is going in the reverse direction that you want. Yeah. Coupled with the fact then you've then got to think about strategically how you put together your kind of your team. So is that 10% in person, 90% remote? And if you're trying to drive people to get back into the office and you've got this really dogmatic approach of no, we want everybody in the office, well, actually, that's going to work against you strategically when it comes to kind of hiring and talent. So you and I, Julius, we've both moved out of London. You know what I mean? I would say that we are of that demographic that's kind of almost like we're skilled, we're high performers, et cetera, but we've decided that actually living in London doesn't make it any more sense to us now.
Yeah.
So we are, part of that statistic and trend where now, if I was to consider, kind of working for a company, I'd be like, look, I'm either 100% remote or a day every couple of weeks I'll go into London and you will subsidize that. And if you can't meet that criteria, then I'm not interested in your business, regardless of the opportunity.
Yeah. I mean, you're totally right. It's a massive problem for businesses. I am very lucky. My company allowed me to move out of London. I only have to go to the office once a week now. But obviously, a lot of businesses are not that flexible, right? But so that also means that you're potentially losing out on talent, because exactly as you said, you are losing out on a certain talent pool. if you have jobs where you say, okay, this job can potentially be done remote, or we might actually require that person to come in only once a week, then you can actually widen your talent pool that way, right? But if you
Yeah.
like insist on people being in the office 3, or even there's companies who are like returning to 5 days in the office now, well, I mean, that will really narrow their talent pool. And it also helps in a way with compensation, right? So because actually people really value that kind of like that flexibility of not being in the office every single day because of commuting costs. They're very high here in England. If you have to be on a train for an hour coming from way outside of London, the commuting costs are very, very high. But if your company allows you to move out, well, then also potentially from a recruiter's perspective, you don't necessarily need to pay the London wage anymore, right?
Absolutely.
So
Absolutely. And only if we had a kind of VP of people in a major European city to give us a perspective on on what that is in a real world scenario, Matthias.
Yeah, it's really interesting to listen to this. My first thought comes to my mind is like, okay, now everybody goes back to remote, right? We have practiced this in the pandemic, so that's the way going forward now, and nobody's in the office anymore, right? This is very straightforward. I think I was just thinking a bit, Julius, about you mentioning 9 times the income and what does that look like for Berlin or Germany or in general. I would even say to a certain extent, and I would just focus on the Berlin market, not so much on the German market overall, that I see a little bit of like comparable tendencies there as well. Yeah. And for me as well, as similar to both of you, I'm not living very much in the center of Berlin. If there's ever a center of Berlin, that's a different conversation. But generally speaking, it's like 30 minutes outside of Berlin, but it's still considered Berlin. So it's a wider outer skirt or suburbs. But in the end of the day, yes, I tend to be in the office quite some time, and we also think about this. But it's not like five times a week. And I do see this problem as well. Every time we relocate international talents, I'm a little bit worried where people are like, yeah, I find a flat easily in Berlin. I'm like, no, please get help. Like this is not going to fly. But it's probably not that extreme. I mean, what I have seen in Berlin, for example, is that there was a momentum where buying a house is actually much better and straightforward than renting, because your purchase, the buying power, the purchasing power, and the money you need were similar to what you would invest in renting a house, right? So it was actually more beneficial to say, I'm going to get myself an apartment and then pay all the taxes and loans, because what was good at that time, I think that was still within the pandemic, the interest rates was rather low, right? And that makes a difference. So, but if you guys don't have a low interest rate and you struggle with that, then this is really, really dangerous. Because to your point, Julius, I would say it manifests the status quo of wealth, but it also makes it even worse because there are just a few elites that can actually handle this. But this is also what we see in Germany, that wealth is given over generations, which then actually manifests the privileges that have been established in the past, and therefore it's super hard for people to break that pattern. And similar to what the US is sometimes claiming, right, from a Tellerwäscher, you say in German, like, from from the very bottom to the very up, it's not working anymore. It is actually broken. This system, this story does not fly anymore. You either have a certain wealth, you either have a certain environment, and then you're going to stay there and take it from there. But if you don't have somehow a fair play, then currently it's impossible. And I think this is why a lot of people are dropping out as well, because they say, look, I'm not earning enough. Why would you sell me the dream that I can afford certain things? I cannot. So let me do my own business, or let me do something completely else. And I think this is where the dangerous part is happening right now. It's not a mindset topic. It's more like we will leave, or we'll see a workforce leaving that is not accessible anymore for companies until we pay a certain standard or certain wages. And that is difficult, right? I think this is something where, if you cannot find a good example, we have a working student for legal. And I would have said, this is a very easy to fill role. At the same time, we had like a legal counsel, mid-level and senior. We filled these roles faster than this legal working student role. And it's like bizarre. But you see already the problem, right? Because of what all we discussed right now, there are not so many young people that, find good jobs. And I think this is also, from a demographic standpoint, a really big problem, right? Because then if it's harder for young people to enter the workforce, or they are so they don't see the value add to actually go to this normal way of working in companies, then we really struggle. And I think then, as a society and an economy, we need to adjust.
Fascinating. It is. I mean, it's just having that kind of comparative between the kind of German market and UK market is fascinating. I think you kind of touched upon something there, Matthias, around kind of workers and almost people's inclination to want to work. And you wrote a post again, Julius, about kind of a trend where UK workers don't want to work overtime. Just kind of give us a little or the tax implications of them working overtime as such that is there enough of an incentive there for them? So just give us a little bit more context there. Because again, if you're people, talent leader, founder, depending on your business, obviously, if people are genuinely kind of like, well, I just want to work 9 to 5 and you're not going to get anything more out of me, that's going to genuinely impact kind of productivity, right?
Yeah, definitely. So I mean, this is a problem we're also seeing in Germany, for example, or in other European countries. It's related to marginal tax rates and the welfare state. So that's a little bit of a nerdy topic, but what is the marginal tax rate? The marginal tax is literally the tax you pay on the last pound you earn, right? And so obviously here in the UK, once your income exceeds, I think it's like 50,200 and something, you go from 20% tax rate to 40% tax rate. So suddenly on the next income you earn, you need to pay 40 pennies to the treasury, and you only retain 60% of the last income you earn. But that is not the highest marginal tax rate, right? So the marginal tax rate increases yet again once you exceed other income thresholds. There's one particular cliff situation that is particularly dangerous, that is kind of like kicking in once you exceed £100,000. That is a very high income that would put you in the top 5% of income earners in the UK easily. So people might say, well, we shouldn't shed too many tears for these people, but it is still a massive problem because your marginal tax rate actually suddenly goes from 40% to 62%. That is because on top of the tax, you also have the NHS, you also have the national insurance contribution, and you lose, once you exceed £100,000, you lose your the tax allowance for the first £12,500 you have. Okay. And so what does that mean? Once a worker earns £100,000, and these are people including, for example, doctors, specialist consultants for the NHS, they face an income, a marginal tax rate of 62%, all the way up to £125,000 of income. So for every extra pound they earn, they only get to keep 38% of that. So, and that doesn't really incentivize you to work more. So if we want to fix the NHS, which has like this insane backlog, for example, right? And Labor said they would try to, and promise that they would try to fix the NHS. We need doctors potentially to work overtime, to put in longer hours, and maybe a lot of them actually also want to do that because they have a family, they need to the extra money, they have a mortgage, they have several kids. But if you face a marginal tax rate of 62%, your incentive to work extra hours is basically zero, right? Again, there's ways around that. You can put that money into your pension, and then it is not taxed. So you can put your extra income into pension contributions here in the UK to avoid that taxation. But there's a limit to which you can do so. And it doesn't really help you right now. It will help you in the future once you retire in 25, 30 years from now. You have a bigger pension, you have a bigger income then. But your net income right now is literally capped. It doesn't help you with your mortgage right now. It doesn't help you with your income right now. So again, these marginal tax rates are a massive problem. And actually, they are also higher marginal tax rates than 62% even, and they are kicking in at lower income thresholds as well. So I think some of them are kicking in at around £60,000 because there are thresholds when child subsidies are being reduced. And if you have a student loan on top of that, so if you have several kids, then there's these welfare benefits that are being phased out at certain income effects. And so that means that for every extra pound you earn, you get money taken away in terms of these benefits. And so actually what that might mean is that some workers actually face even higher marginal tax rates than 62%. Some of them might face marginal tax rates of up to 70, 80%, potentially higher, depending on how many kids they have and whether they still have a student loan. And so if you face these marginal tax rates, then your incentive to work more or to get a promotion is literally zero. There are scenarios where people theoretically have a higher gross income, but it has zero effect on their net income. And that is a massive problem.
Yeah.
And these kind of things actually exist in Germany as well because of these different welfare aspects, these different benefits that we've faced in over the last couple of decades with, like, you get child benefits here, you get housing allowances there, but there are income thresholds where all of these allowances are being taken away. And so that might mean that even if you actually theoretically earn €1,000 more, well, if you get all of these allowances being taken away, your net income is actually exactly the same. So what's your incentive to work longer hours? What's your incentive to kind of like aim for a promotion or to change to a better job, which would be in the interest of the economy as a whole? So, and this is something that doesn't exist in the US, right? Because they don't have this welfare state with all these benefits and allowances, and they have significantly lower taxation rates. Like if somebody would tell them, like, I make close to 100K, but my marginal, or 100K, my marginal tax rate is like 62% now. In the US, like, I work for a US company, nobody there understands that. They think you're crazy. They think you're like absolutely nuts, right? They're like, what? And so 10 years ago when I was a student, I thought like the biggest problem after the Great Recession is like mass unemployment, weak economy. But now I see more and more that our tax structure, the regulations, all the regulations we have built in Europe in the last couple of decades, when it comes to building housing, when it comes to the welfare state, when it comes to labor market regulations, when it comes to these insane marginal tax rates, that all of these actually do have, when you take all of them together, a big negative effect on the economy and the labor market. Because it is a massive problem if people, our most productive people, doctors, NHS doctors who earn maybe 100,000 or whatever, or consultants or people in tech who earn that amount of money, we want these productive people actually to work longer hours and to contribute more to the economy and not less to the economy. So that it is a big problem.
Yeah, I couldn't agree more. And I think actually what you are saying is that this is not a topic for recruiters anymore because they are confronted with this, but actually it has to be a topic for executives and people leaders who do these, agendas and keep this in mind and think about this, right? Because as a recruiter, you literally need to know about these trends and need to figure out if I work for a new company and they don't get what's happening at the market, you rather not going to take the job and go somewhere else where they get it. But I think that is really, really important here, because honestly speaking, I don't know if people are aware of these trends, right? And I think to your point, we have something similar in Germany. The taxes we pay are super high, and then the conversation is does it make sense to work more? Does it make sense to get more scope? And if you have more scope, more responsibility, yes, you have a nice career traction, but it has almost no effect in your net income, and that is dangerous.
Yeah, it's a massive problem.
Yeah, I completely agree. And I think, Matthias, you touched upon something there, which I think will have an implication on kind of recruitment. So if we think of the UK, and based on what we've just discussed here and Julius has outlined, right, the winners at the moment, even though there's green shoots, there is underlying volatility. The winners, businesses, are going to be the people functions that have adaptable people strategies. And there's probably three key areas that you'll focus on, right? You'll focus on internal mobility. You'll focus on investing on training up and upskilling your talent. And you'll equally focus on more comp and bends than salary, right? So those three things will be the people function focus. And I think the net impact of that will be, there'll probably be an increase in kind of recruitment as a service, right? You'll reduce your internal recruiter function because, you know, the demands in terms of hiring will peak and trough. And if that person can only recruit, you can't afford to hold them within the team full time. So you'll outsource that bit, and actually the people function then will focus more on how do we maximize kind of ultimately the talent we have in the business. How do we offer more kind of flexible working patterns, etc.? How do we, you know, to Julius's point there, right? If certain individuals are in a high salary, how do we construct a benefits package that really invests in them short and long term and actually present that to them as opposed to trying to compete on salary alone? So I think there's going to be some really interesting changes to the people and talent team internally versus what you would outsource and kind of just bring in external suppliers to kind of deliver for you, know what I mean? Mm-hmm. And then you just wrap in the simple, you know, small fact of kind of AI and the implications of that within kind of recruitment. And then you've got this kind of perfect storm. But Julius, just as a kind of wrap up, what advice would you give to kind of people and talent leaders, founders, you know, kind of UK centric at the moment? What's your kind of guiding line, other than if you're not fully aware of this type of conversation, this information, this type of topic, the sources of it, start to make yourself bloody aware quickly.
Yeah, I mean, it's I think the kind of like the environment we're in right now is probably relatively challenging for talent acquisition, right? Because one, we came out of a very kind of like hot labor market 2 or 3 years ago where everybody was competing for workers and there was a record amount of open positions and vacancies. And now we almost have the opposite scenario, slowing economy, slow labor market, and not too many companies are hiring right now. And on top of that, we have AI, which is something very new still, and it is transforming our economies and the labor market in a fundamental way. The impact in the short run might be still somewhat limited, but I do think it will have some big impacts in the next decade, obviously. And we have all this global economic volatility with like Trump and the tariffs and global uncertainty. So I think it is quite challenging, but I would so you need to be probably relatively flexible in your talent acquisition, in your recruitment approach, right? You just need to be flexible and be aware. You don't need to understand, like as an economist, like every single detail of how the economy functions and like what's going on, but I think you should like be aware kind of like of like the big kind of like economic trends roughly and how they might impact the labor market. Hopefully our blog Recruitonomics can actually help you with that, because I write about a lot of things there. I write about the marginal tax rates. I write about the tariffs, the white collar recession we've seen a little bit, and the slowdown of the UK labor market, and all of these things. Yeah.
Yeah,
Highly
Julius,
recommended.
Julius, this was wonderful. This was really good. I think I always enjoy these sessions with you because I feel like, first of all, time flies. You learn a lot while you're here listening. Then you have these comparison, and I think it really is something that is very important for the talent leaders out there and people leaders out there to understand more how labor markets function. How do you look at data? What are trends, and what does that mean for your practices and day to day, and the conversations you need to have with your executives in order to create a strategy that actually makes sense and helps organizations to make the best talent acquisition approach or even talent approach for their business. Now, this was very, very great, lovely. Glenn, I think Julius will be back probably in next month or two. Let's see what's happening in the world. But
yeah, exactly. I mean, there's plenty more to talk about. Let's put it that way. And just a simple kind of like update in a couple of months' time will be super interesting. But Julius, I genuinely, I fucking love this, man. I really do. It's such a great conversation with you. And we will be promoting the hell out of your kind of your posts, your articles on a weekly basis. But yeah, thank you. Thanks.
Thank you so much.
Thank you so much for having me. This was great.
Thank you.
Great conversation.
Julius.
Yeah, thanks so much.
As always. And see you soon.
Okay, sounds
Bye-bye.
Perfect. Sounds good. See you soon. Bye.
Okay.
Bye.